Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 221 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvily, bring you everything you need to know from the past week in the world of financial markets and financial planning. So I think for the third or fourth week in a row, Nick Whitaker, our Director of Research and Trading, back on the show. So welcome back, Nick. Thanks for joining me this morning.
Thank you. I was saying it's nice to have a good run in the team.
Yeah. So, as always, we will review quickly the month-to-date and year-to-date performance numbers, the major market indices that we track. This data is from YCharts, and as of October 5th, 2023. S&P 500 index is down 0.7% during the month of October, but up 10.9% on the year. The Dow Jones Industrial Average down 1.2% on the month and down actually 0.1% on the year. The Nasdaq Composite Index is flat for the month and up 26% for the year. The Russell 2000 Small Cap Index is down 3% for the month and down 1.7% for the year. And the All World X United States ETF down 1.7% for the month and up 1.7% for the year. The 3-month Treasury rate sitting at 5.61%, the 2-year Treasury rate at 5.03%, and the 10-year Treasury rate at 4.72%. So Nick, kind of the weakness that we've seen the past 2 months has kind of carried over into the beginning of October. It's actually interesting, like the S&P 500 is one of the very few indices that are kind of like still doing well or hanging in there in terms of performance for the year, up 10.9%, but the average stock is pretty much like break even or even negative right now, which is very interesting. You got the Dow that's in negative territory for the year, several other industries that are in negative territory for the year. So I think it just speaks to the market cap weightedness of the S&P 500 with, Microsoft, Google, Apple, Amazon, Tesla, Nvidia, all still relatively strong this year, kind of carrying that index higher.
And same story for the Nasdaq too, right, on the year.
Mm-hmm.
Yep.
So other than that, big headlines, current events from the week. The government shutdown was averted until November 17th. So people in Congress apparently just kicking the can down the road. We're going to have the same issue on the 17th of next month. So that'll be interesting to see if a longer term spending package that gets agreed upon, or if it's going to be another short term bill, or the government shuts down. So TBD on that topic. Another thing, Nick, I'm sure you saw that House Speaker McCarthy was ousted from his post, and I believe that's the first time in history that has happened. We've been getting a couple of questions. What is that impact on the markets? And it's really a nothing burger, in my opinion, from the markets. It's kind of just clickbait headlines. We all know that Congress is, for lack of a better term, quite a clown show, I think, on both ends of the aisle. So this isn't surprising to me, but when it has to do with the stock market, it's really a nothing burger, like I said.
Yeah.
The only other thing I wanted to note, which we just talked about, Nick, is the continued market weakness coming into this month in the first, 5 trading days of this month. But we do know that, October tends to be a month where markets bottom. It tends to be the start of this so-called Santa Claus rally and this run up into the end of Q4. So all of the data that we have suggests that we're going to receive that at some point. It just might take a little longer than expected, and that kind of leads me right into one of my first items of research that I had for listeners this week, Nick. It was a chart presented by All Star Charts, and it shows presidential cycle seasonality. So it kind of breaks up the chart into four separate periods. So, the first year, or what they call the post-election cycle, the second year, what they refer to as the midterm cycle, the third year, or the pre-election cycle, which is the year that we're in right now, and then year four, which is the election cycle. And Jenna will throw this up for our YouTube viewers, and this will be in our show notes, but this is a really good chart that kind of outlines the weakness that we're experiencing right now. Really isn't that uncommon. But the funny part about it is, once we get into the election year, markets tend to usually resume their uptrend. Now, am I saying that that is exactly what's going to happen? No, absolutely not. But, going back and using history as our guide, like we always do, election years, regardless of who the president is, tends to be pretty strong. So, again, markets are somewhat oversold on a short-term basis to a certain extent, excuse me. So I would kind of expect to see strength in the market over the next couple of weeks here. And, another piece of research that I just wanted to add to this, Nick, to kind of back up my thoughts on why I think the market is going to go higher into the end of the year. The next chart I had was just a chart that I pay close attention to on stock charts. And what this shows is the S&P 500 in black in the upper panel, and the consumer discretionary sector versus the consumer staples sector in the bottom panel in blue. And what this chart tells us, Nick, in my opinion, is that people are still putting their money into risk on areas of the market like consumer discretionary. Again, those who might be new listeners, consumer discretionary stocks, obviously, as the name implies, it's not a necessity, but if consumers have income that they're able to spend, these are the type of names that they buy. Consumer staples, on the other hand, are what we refer to as necessities: toilet paper, toothbrush, toothpaste, all of that stuff, right? Products that Procter and Gamble produces. That's what we think of when we think of consumer staples. And in a risk on environment, you would expect consumer discretionary to outperform consumer staples because it's discretionary spending, right? And if the American consumer is hanging in there and doing well, theoretically, they should be spending more money with these companies that make up the consumer discretionary sector. And what we're seeing right now, Nick, and what you can see on the chart is that consumer discretionary stocks continue to outperform consumer staples even in the midst of this market sell-off in the S&P 500. And I feel like if we were in for a prolonged downturn in the markets, we would start to see consumer staples outperform consumer discretionary first, because those are more risk off assets. Okay. So, again, just one of the inputs that we look at from week to week. Consumer discretionary stocks are still very strong, continue to be strong. And until those really roll over versus consumer staples, I'm really not too concerned with this short term market sell off that we're getting.
Yeah, exactly. We've seen a little bit of that sector rotation into some cyclicals, but we've not seen that defensive rotation that you're talking about.
Right. And another a sector that's, defensive is utilities, for example. And utilities have
perfect
been
example.
getting absolutely crushed. Now,
Crushed.
I think that's due to bond yields where they are, because everyone's like, why would I own a utility stock that pays a 3.5% dividend where I can buy a short-term US Treasury bond that's paying me 5.5%? So I think that's a different conversation. But other risk-off sectors, Nick, like healthcare and real estate, those sectors are also getting crushed relative to the market, kind of like consumer staples. So, again, if I thought this was going to be a longer term sell off, I would want to see rotation to some of the defensive sectors, and we're just not seeing that right now.
Yep, absolutely. Very, very well said.
Moving on to my second item, another topic on seasonality. So this chart was from the Stock Traders Almanac, and this talks about election year seasonality. So we just, Nick, talked about the election cycle over 4 years. Now we're just looking at what does a typical election year look like for the S&P 500. So if you're looking at this chart, the black line is all election years going back to 1949. So the average election year is up, looks like about 6.5% on average going back to 1949, Nick. And the thing that I want to highlight here is that when the sitting president is running again in the next election cycle, that's notated by the green line in this chart. The S&P 500 on average is up close to 12.5%, so almost double the performance of all election years when you have a sitting president that's running again. And I know we can get into the weeds about what the Biden administration has done poorly and what the Biden administration has done well and our feelings on President Biden. But just looking at the data, usually tends to be a pretty good thing for the market when the president is running again. So just wanted to throw that out there. This is another important reminder because we're just about a little more than a year away from the next presidential election. Is it's so important to separate your investment portfolio from your political feelings, right? Um, like I've talked
Absolutely.
about before, there are a lot of people out there saying that Trump was going to wreck the economy. There are a lot of people out there saying that Obama was going to wreck the economy. And in my opinion, I don't think either of them wrecked the economy, right? Two different
Yeah.
political parties. Markets were, pretty good through both of their terms, right? So just an important reminder that political talk is going to start to heat up. You're going to start to see more people talking about the presidential election as it relates to the markets and what impact that's going to have. But again, a lot of it is just noise, and I would encourage people not to make emotional based decisions based on politics coming up over this next year.
Yeah, I don't have anything to add there. That's well said. Yeah.
Uh,
They're
la-
two independent things, like you said.
Right. So the last thing I had, Nick, was a chart from Ari Wald at Oppenheimer, and this was during a 2-day chart summit last week, which has been great. I'm kind of catching up from all the presentations that they had. This was interesting to me, Nick. So it takes a look at sector outperformance rates in bull markets. So what Ari did and Oppenheimer did was they went all the way back to 1932. They looked at all of the different sectors during a bull market and said, hey, which sectors tend to outperform during bull markets the most? And I don't think it's going to come as a surprise to anybody, but technology outperforms the market 87% of the time when we're in a bull market. So this kind of narrative, I think, that's been in the market that technology has only been strong for the past decade or the past 2 decades, that doesn't carry much weight to me when I look at this chart. Going back to, the 1930s, the 1940s, the 1950s, technology was a consistent outperformer even way back then, almost 100 years ago, right? So I think this clearly shows that, when times are good, tech is going to do really well on average, right? And I thought some of these other outperformance rates were interesting, Nick. Financials and bull markets only outperform 57% of the time. And then consumer discretionary coming in second place outperforms almost 75% of the time. So when we're talking to clients and we're talking on this podcast about being overweight technology, consumer discretionary, and industrials during bull markets, this is the data that backs that up. We want to have uh, allocations to these risk on area of the markets. And for example, Nick, if we're in a bull market, why would we want to have really any utility exposure when utilities outperform in bull markets only 17% of the time? So these are the things that we think through when we're making investment decisions for our clients. And again, I think it's sometimes a thing that gets passed over by a lot of people, that they think that we should just have, equal exposure to all the sectors. But I think this piece of research states pretty clearly, which sectors do well during good times and bad times.
Yeah, absolutely. It doesn't, the research doesn't surprise me too much, just thinking about market cycles and what we've kind of talked about with bull markets and bear markets, what we expect. You'd expect utilities to be really have a low percentage. Healthcare is a little high for what I was expecting, but it still makes sense, right? Staples is lower, expect that. Materials is lower. I definitely expect that. That's another that can be kind of roped into a defensive move. Lots of higher dividend names in that space.
Hmm.
And energy, some of the cyclical trades in there are kind of, that's where you're like middling. Like energy, um, industrials is a little better, but financials is kind of in the middle ground, which makes sense because they can be a little more cyclical at times. So.
Right.
Yeah, it all makes sense. Makes perfect sense to me.
Well, I know that you want to talk about sectors and subsectors next, so I'll hand this over to you.
Yeah. Yeah, we're really themed today. And listeners, we did not plan that. That's just how it happened. But I I have a couple charts here, and I wanted to talk about market sectors and subsectors, and um, just throw up some cautions about generalizations that we talk about, and really just give some extra education to listeners. I'm sure a lot of listeners will understand this and perhaps know it, and I'm sorry if I'm repeating things that you're already aware of, but hopefully someone finds it helpful. Um, so I have three charts here. It's a sector reversion chart showing the first half of the year and then what we saw in Q3. So price performance. This pricing data comes from Y charts. And your blue bars are your first half, your gray bars are your Q3. And this first chart shows your sector performance. And you can see the reversion there. You can see energy getting a bid in Q3. Um, and you can kind of see where the reversion lies. What we were talking about earlier with technology, communication services, consumer discretionary. In this chart, it's called consumer cyclical. For whatever reason, all these different research pieces love to change the name of that sector. You've got
Yeah,
consumer
that's
cyclical,
a
consumer
good.
discretionary, consumer durable. I mean, there's all
They're all
kinds of
one and the same. Yeah, it's
it,
it's a little annoying that they
it,
have so many
yeah.
different names.
Y charts calls it consumer cyclical, but think of it as consumer discretionary. So what you were talking about earlier, Mark, with not seeing that weakness as much as one would expect going into a bear market, you can kind of see that in this chart as well, where utilities down in year to date, continue to ride down Q3, and you see that with the opposite with tech and consumer discretionary. But what I really wanted to talk about today is the idea that not all subsectors are or industries are created equal. And I wanted to look at this first chart and then take a quick like zoom in on two examples to kind of explain that to listeners. Constantly the market and the media, we're talking about, tech is flying or energy is doing really great. And I just want to caution listeners, because I've talked to clients about really understanding what you're invested in and understanding that sometimes just saying tech is flying, there's more to the story than that. There's always more to the story. You can peel the onion back one more layer at a minimum. You can continue to go through. So let's take a look at the technology, for example. These are the subsectors or the industry levels of the tech space. And same chart. You can see the performance first half, and you can see the reversion in Q3. And you can see where most of the leadership is in the sector. And this is what I'm talking about of not all sectors are or subsectors are created equal. When you peel the layer back, what was really driving the pricing and the sector, you can see most of it coming from three subsectors. So when someone says, "Oh, you need to go out and buy some tech," you could have bought IBM, and you would be in that bottom category down there, up, you know, 1.7% to date, right?
Hmm.
In that subsector. Looking at the next example in energy. Energy is another one. Real estate, basic materials. I mean, you can go through this for all the sectors. I picked these two um, primarily because energy outperformed in Q3 and tech outperformed in the first half of the year. So I thought that'd be timely for listeners. But energy is another one where these subsectors are drastically different when you really look into it. And okay, energy was up in Q3, but what was leading that? Coal, surprisingly, was leading that, right? Yeah, E&Ps, that's exploration and production. Then you have refining, integrated, drilling, equipment services, um, and then midstream. But going back to the thesis that I'm kind of trying to put out here to the listeners is, you know, your underlying investments within a sector can be drastically different. So midstream, for example, is a very high dividend paying. You tend not to see a lot of volatility. Well, I shouldn't say that. You tend not to see as much volatility per movement of oil, metric of oil. So if oil is up 1%, you're going to see your E&Ps and your drillers and your equipment and services stocks move higher than you would with your midstream names. Um, and E&Ps on the other side of that spectrum, where E&Ps are riskier companies. They have higher betas. So as oil goes up 5%, you would expect those companies to increase more than other names in the energy space. It's kind of like a risk spectrum within the sector, right? And
Yeah,
then
and
in
just to for people to understand kind of beta, Nick, when we talk about, beta, a higher beta name means that the name is pretty much, simplistically just more volatile than the sector itself, or the S&P 500 is usually what it's
yeah,
compared to. So whenever someone mentions low beta, they're usually talking about a lower volatility stock, maybe like a Pepsi or McDonald's, or
yeah,
Procter and Gamble, based on history. Whereas a higher beta stock, or a higher volatile stock, could be a name like a Tesla, for example, that most people could
absolutely.
sympathize with. So
Yeah, the way to think about that would be, okay, the S&P goes up 1%. A name with a higher beta is going to go up a higher percent than the S&P. It's going to move more. So, obviously the direction, it's not guaranteed it's going to go up just because the S&P goes up. But a lower beta stock, let's say they're both moving up in the same direction, the S&P will go up 1%. Maybe it only goes up 0.5. That's a lower beta. So
mhm.
that's a good way to think about it. But I just wanted to toss this out to listeners and just show them something a little different. I don't know if you have anything else to add on this
No, I
kind of
think it's
thought.
good. I mean, obviously, in the tech sector, through the first half of the year, semiconductors and software and consumer electronics dominated, but information technology services were, pretty much flat, right? So it's just
Yeah,
interesting to see, when we say technology is doing really well. Yeah, like most of technology is doing really well, but there are certain areas that are not doing well, right?
yeah, yeah. And there's pockets of weakness and pockets of strength in every subsector, every quarter, every month. Even, I'm sure we could find a utility that is, doing
Oh yeah,
probably
I
not
could.
probably not great, but
Yeah, and there's some REITs that are
probably middle
doing
of the
well,
road.
but it just increases your probability of success when you are in sectors and in industries that are doing well. The stocks within those sectors have a higher chance of a better return, just because the overall sector and the
Yeah.
overall industry is strong. I think people have done research on this. I think,
Mhm.
don't quote me on this, but it was something like, you know, 40 or 50% of a stock's return is, based on how well the industry group is doing. So
Absolutely.
so that
Absolutely.
matters a lot, and that's why we're talking about it.
Yeah, and I studied that a lot for years in my prior role, where you would see that it's good company, good name, and everything's going well. The balance sheet's clean, investors like it, but it's moving lower because their industry group is moving lower, and a lot of that gets down to macroeconomics and market dynamics. So that's why
Yeah.
this stuff is important, and just thought I'd kind of show. I think we talk a lot about sectors. I think the media talks a lot about sectors, but I don't tend to see that kind of extra layer as much. So I just thought I'd throw that in there. The next piece of research I have is actually also from All Star Charts. That's two this week.
Big
Shout
fans.
out, JC Peretz.
Mhm.
This is a tweet. He says the Nasdaq just closed yesterday at the highest level in history relative to the much broader Russell 3000 index. The Russell 3000 is 3,000 tickers that range from really large, the biggest names in the market, all the way to little tiny micro cap names that you've never heard of. So it's a very big, broad index. And then there's the chart there, and you can see it's a relative chart of the QQQ and the IWV, which is the Russell 3000 ETF. And you can see we've talked about it a couple times that it's still holding up. And a bear market, you wouldn't expect this to be holding up. Or in the months and the quarters preceding a bear market, I should say, you wouldn't expect this to hold up.
Yeah, and QQQ is heavy inside of tech, and it just goes to show you that a lot of these big technology names are what is driving a lot of the performance this year, especially in market cap weighted industries. And I think this is a positive for the market. I know there are people that are concerned with it's just a couple names doing really well this year, and it's like, okay, that's fine, but like we just talked about, tech is the leader when we're in good times. And until tech starts to roll over, I don't think that there's going to be a huge problem for the markets.
Yep, absolutely agree. The last piece I have is just a quick quote from Peter Lynch. And I picked this up from a tweet from Investment Wisdom, and the quote is the following: "People who succeed in the stock market also accept periodic losses, setbacks, and unexpected occurrences. Calamitous drops do not scare them out of the game." Peter Lynch. Peter Lynch is a very famous, successful mutual fund manager. I believe it's Fidelity, right?
Hmm.
Fidelity,
Yes, it was.
a mutual fund manager. We're talking decades of very strong performance.
Hmm.
Very fundamental stock picker. A lot of, yeah, I think there's books out there you could read about him. But I think it's a good quote. It makes sense. There's being in the market sometimes is not easy. There's ups and downs. There's lots of uncertainty, and it's just one of those things that you work with your advisor. You set up your risk tolerance. You try to understand, how much are you willing to uh, deal with the volatility, and then you accept it from there, and trust that over your lifetime the market is going to help you achieve your goals, which historically it does, right? It's not fun going through those times, but that is the market. That it will always be that way. If it was
Yeah,
easy, if it was
it's
easy, everyone would do it, right?
right, exactly. So
So
it's just, yeah, it's a good couple of lines there by Peter that, pretty much the name of the game is just focusing on the long term and kind of just cut out all the weekly, monthly noise, right?
yeah, yeah. Don't focus so much on the past. I mean, we talk all the time about it because we're in the industry. It's our job to do that. So we're very focused on the short term as well as the long term. But I think for the average retiree or the average investor who's watching CNBC every day, or MSNBC or Fox News, or whatever, however you consume your news, I think it's important to think about this quote, and always just take a deep breath, there's going to be ups and downs, and that's just how the market is. So
Yeah. Well, Nick, just really quick for our financial planning topic of the week, just a couple of reminders for people. The extended tax filing deadline is on October 16th, so not this upcoming Monday, but the following Monday. So if you are someone who has extended your taxes, that filing deadline is coming up soon. Another reminder, we are getting closer to the end of the year. So if you have not contributed to your IRA, you can do that before year end. Obviously, you have until your tax filing deadline, which is usually in the middle of April, to make prior year contributions for your IRA. But if you want to just get that done before the end of the year, it is a good time to do so. Also, just looking like we've talked about, Nick, with the seasonality and performance of market into Q4, I don't think it would be the worst thing in the world to put some money to work right now. Last thing in this realm, Nick, is charitable contributions. So I know a lot of times people are charitably inclined, and they tend to do this towards the end of the year when they know what their tax liability is going to be. So if that means opening a donor advised fund or making a qualified charitable distribution from your IRA, we want to make sure that we have enough time to get that stuff done before the end of the year, and we're not cramming it into the last week of December, because once holidays come around, time goes really quick, and there's going to be certain days where offices are closed and your advisor might not be working. So if you are charitably inclined, I would encourage you to reach out to your advisor to kind of get that conversation started. Before we leave it there and talk about a sponsor, Nick, anything else that you wanted to mention while we are on the call today?
No, lots of sector and subsector and rotation talk for everyone. So hopefully listeners enjoyed it, and thanks for having me as always.
Yeah, and before we sign off, Nick, just wanted to let people know that if they are interested in starting their own podcast, you can get your first month of Blueberry podcasting hosting free with the promo code Jessup Wealth, all lowercase. Use the hosting estimator on their site to determine the best plan for you, and don't forget that's Jessup Wealth for your first month free. All right, everybody. Thank you for tuning in to episode 221 of the Independent Advisors Podcast. Nick, thanks for joining again, and we will be back with you all next week.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.